Well, welcome everybody. Thanks for being here. Good evening, good morning, good afternoon, wherever you may be in the world. I appreciate you being here. My name is Tim Burkwood. I'm the co-founder of Trader Interviews and also the Traders Expo. Uh, we have a great presentation for you today. Alan Ellman from the Blue Collar Investor is here. I met Alan a little over a year ago, and I approached him to be a speaker at the Traders Expo. And from the moment he stepped into this workshop room, he was one of the most popular speakers at the expos. And so his website's become very popular as well, and he's got some great information for us today about covered call writing. Barry is also in the room. You won't probably hear from him, but he will be answering your questions in the question box. So if you have any questions while this is going on, Barry can answer all of those in real time while you're watching Alan's presentation. So I will answer the first question, which is always, is this being recorded? Yes, it is. You'll get the link in your inbox sometime late tonight or early tomorrow morning, so you can watch this over and over again to your heart's content. So I will turn it over to you, Alan. Thanks very much for being here.
Well, thank you very much, Tim, and thanks to all of our guests for attending tonight's webinar. My topic is creating a monthly cash flow with covered call writing. To those of you new to this strategy, covered call writing is a strategy that encompasses two other strategies. First, stock ownership, which I'm sure you're all familiar with, and the other one is option selling. And I want to highlight the word selling because that implies that we're going to be receiving a cash premium for undertaking an obligation. And that is precisely what covered call writing does. It creates a monthly cash flow. So that being said, let me start with the typical disclaimer that you're all used to seeing. And you're going to see lots of trades that I've made using this strategy in tonight's presentation. And I want you to know that those trades were appropriate at the time that I made them, but may or may not be appropriate today. So use this information for educational purposes only. Now that being said, let me get started with a preview example. So once I give you all the basic and advanced principles for covered call writing, all that will come alive having this preview example in the background. And what we're all going to do now is we're going to purchase 100 shares of stock. It could be any company. We'll call it company XYZ. And we're going to purchase that at $48 per share. So our cost basis or our investment is $4,800. Now, once we own these shares and we're in a protected or covered position, we are then free to sell the option. What we're doing here is we're selling someone the right, but not the obligation, to purchase these shares from us at a price that we determine by a date that we determine, and in return for undertaking this obligation, we are paid a cash premium that the market determines. Now, in this hypothetical, we're going to purchase the shares for $48 and agree to sell them for $50 at any time over the next 1 month. Now, a typical premium in a situation like this would be about $1.50 per share or $150 for the 100 shares. Now, a $150 initial profit on an investment of $4,800 represents a 3.1% 1 month return. If we could do that every month, that annualizes to 37%. Now, at the end of that 1 month, there are two possible major outcomes. In the first scenario, let's assume for a moment that the price of the stock never supersedes the agreed upon $50 sales price. Let's say, for example, it just remains at 48. Well, the option holder is not going to opt to exercise that option and buy our shares for 50 when they can be purchased at market for 48. So the option expires worthless. We keep the $150 no matter what. I want to get that out up front. That's our cash to keep no matter what happens. In this scenario, the option expires worthless. We keep the $150. We still own the stock, and now we're free to sell another option the next month. So our 1 month profit is 3.1% on the option side. The other possible scenario is the price of the stock does go past the $50 agreed upon sales price. Folks, even if it's 1 penny over the $50, those shares are going to be sold unless we take some action, which I'll discuss later on. But let's assume for a moment that we take no action and we allow our shares to be sold for $50 at the end of the 1 month. Well, now we've made an additional $200 on the sale of the stock for a total of $350. $150 from the sale of the option and $200 from the sale of the stock, from 48 to 50. That's a total of 7.3% 1 month return. Now, if we could do that every month, that annualizes out to 87%. But let me tell you right now that not every trade every month is going to turn out like that. But in normal market conditions, you will see trades like this and you won't be amazed. It will happen. Now, despite whatever strategy you decide on, you need to be able to talk the talk. So there are some definitions that you need to be familiar with. There aren't a lot. Let's review them briefly. First of all, an option is a contract. It gives the holder the right, but not the obligation, to buy or sell 100 shares of stock at a fixed price. That's called the strike price, and it was $50 in the preview example, by a specified date, and that's called the expiration date. Most options expire on the 3rd Friday of the month. Now, a call option gives the right to buy 100 shares of stock at a specified price. And in tonight's webinar, we're only going to be dealing with call options. What we're doing here, folks, is we are selling the right, but not the obligation, for some unknown person, because everything is done online, to buy our shares from us at a price that we determine, by a date that we determine, and in return for undertaking this obligation, we are paid a cash premium that the market determines. And that cash is generated into our account instantaneously and available for us to use either right at that moment or the next day, depending on which brokerage you're using. Now, a put option is the opposite. It's the right to sell 100 shares of stock at a specified price. We will not be dealing with put option in tonight's webinar. All right, let's talk for a moment about the option strike price. Remember, that's the price we agree to sell our shares for as it relates to the price of the stock. We have 3 definitions here. At the money, that's where the strike price of the call option is the same as the market value of the stock. So, for example, we buy a stock for $50 and agree to sell it for $50. Believe it or not, folks, we're going to get paid for that. The in-the-money strike is the one that's the most difficult to understand and one of the most underused strike prices. And we're going to talk about that a lot in tonight's webinar, because understanding how to use the in-the-money strike price, I promise you, is going to put cash in your pocket. In this case, the strike price of the option is lower than the market value of the stock. So, for example, we purchase a stock for 56 and agree to sell it for 50. Now, you say, why would we agree to do that? Well, the answer is the option premium that we're going to receive for selling this option will compensate us for that $6 difference plus a little bit more. That little bit more represents our profit, not the $6 we're going to lose from selling the stock. And I'll show you an example in just a moment. And that's called the in-the-money strike price. Now, the out-of-the-money strike price, which is the one we gave in our preview example, is the most popular of all the strike prices used in covered call writing. The example we gave, we buy a stock at 48 and agree to sell it for 50. Now, the reason it's the most popular is because you have an opportunity to generate cash not only from the sale of the option, but also from share appreciation. So it's a very bullish position to take, and the most popular of all the covered call strike prices. So we have 2 more definitions now. And before we get into them, I'd like you to take a look at the equation at the bottom of this screenshot. The option premium, or the cash generated from the sale of the option, consists of intrinsic value plus time value. Now, intrinsic value is the amount that the option is in the money. So therefore, only in the money strikes have intrinsic value. The example we gave before was you buy a stock for 56 and agree to sell it for 50. So if you got an $8 premium for selling that option, of that $8, $6 is intrinsic value, not profit. That's the amount the strike price, $50, is in the money compared to the $56 price of the stock. So of the $8, $6 is intrinsic value, not profit, leaving us $2 of time value, our initial profit. Okay, so if you sell an in-the-money strike, you cannot count the entire premium as profit. What you'd be doing then is exaggerating your results, and we don't want to do that. All right, so we're going to see some examples of this as the webinar progresses. So if you didn't quite grasp that, we will be showing it to you a few times more. So selling covered calls is buying a stock and selling call options on a share-for-share basis. If you want to sell one options contract, you must first own 100 shares of stock. If you want to sell 5 contracts, you must own 500 shares of stock. Now, if you own, let's say, 199 shares of IBM, you can only sell one options contract. So therefore, when you purchase shares for purposes of covered call writing, you always purchase them in 100 share increments. Now, before you invest and risk your hard-earned money, you have to have reasons why you're doing it. And the reasons shouldn't be because I said so, or because some screaming guy on TV said so, or some newsletter told you to do it. It should be because you've educated yourself and you've made a non-emotional decision that this is the right strategy for you. Now on this slide, I've listed 9 reasons why I use covered call writing, and I'm going to discuss 4 of them, the ones that I've highlighted. First of all the low-risk strategies that I've tried, I get the highest rate of return. So simply stated, more cash as a result of using this strategy. Number 4, one of the things I love is I love to be able to control my outcomes. And this strategy gives you unbelievable flexibility in terms of your final results. I've actually written an entire book on the subject of exit strategies for covered call writing. So once you enter your position, there are ways that you can navigate through situations where the share price declines, or the share price goes through the roof, or if the price of the stock is higher than the strike price as the contract is about to expire, and you may want to hold on to that stock. And we're going to discuss that towards the end of this webinar. So control is a major factor in why I like this strategy. Number 6, you can compound your cash in minutes. Let's say hypothetically you have a nice size portfolio of $300,000, and I know many of you are going to have a lot less and some of you are going to have a lot more. But let's, for this hypothetical, say $300,000, and each month you write covered calls and generate $10,000 in cash. Now, you could take that $10,000 instantaneously, purchase more shares with that money, and then immediately sell options on those newly purchased shares, thereby compounding your money in minutes. I know of no other strategy where you could do that. And number 9 on this list is that the government considers this strategy safe enough where it allows you to use it in your self-directed IRA accounts. And whenever possible, I advise you to do so because you're going to be generating a constant monthly cash flow, and we don't need Uncle Sam as our partner while we're doing that. Now, many of you have attended webinars, seminars, and the speaker would tell you about a strategy or a software program and made it sound like it was a panacea, nothing can go wrong. Normally, when you're getting paid more than a risk-free return, there are some disadvantages. There is a downside. There is risk. So I always like to include this slide in my presentations and let you know so you could assess for yourself whether this is the right strategy for you. Now, let me state the obvious. If the price of the stock declines below the break-even, you could start losing money. Let's go back to our preview example. We purchased the stock for $48 and we sold the $50 call option for $1.50. If the price of the stock starts to decline below $46.50, we could start losing money. Now, we're going to have a whole series of exit strategies in place to mitigate these losses. But I want you to know right up front that there is some risk, and the risk is in the stock, not in the sale of the option. Now, the major disadvantage of covered call writing is number 2, so I would ask you to focus in on this one. The profit potential is limited to the strike price of the option, and let me explain. Let's go back to our preview example. We purchased the stock for $48 and sold the $50 call. Let's assume for a moment now that there's some kind of an FDA approval on a drug that the company owns, and all of a sudden the stock goes from 48, in 1 week it goes to 60. Now, we are obligated to sell at 50, and we'd love to get our hands on those extra 10 points, but we can't because of our option obligation. So our profit potential is limited to the strike. Now, as you saw in the preview example, we did generate better than a 7% 1-month return. Not so bad. So as I say on the slide, don't get greedy. Focus in on what your strategy is. In this case, it's covered call writing. What are your goals? And if you've met your goals or exceeded your goals, as you would have in this case, pat yourself on the back for making a great trade, take the cash, and move into a new position. Number 3, assignment. That means that the option holder exercises the option and buys your shares from you. Now, 99.9% of the time, that will not happen until the Saturday after expiration Friday. However, there are some rare exceptions to that, and I want to make you aware of it. Mainly, the exception would be if there is a dividend distribution. And if that dividend is greater than the time value left on that option premium, your shares may be sold the day before the ex-dividend date. Now, what does that mean? To me, it means nothing, because you've maxed out your covered call trade, and now all of a sudden, mid-contract, you have all this extra cash in your account, which you could use to establish a second income stream in the same month with the same cash. But some of you out there may want to hold on to that stock, and if so, there are ways of avoiding early exercise, and we'll get into that a little bit later on. And it goes back to that tremendous amount of control that I alluded to before. And number 4, and I think this probably applies to any strategy that you want to master, there is a learning curve and a time commitment. Now, for those of you relatively new to the strategy, if you are motivated to learn it and master it, figure 3 to 4 months before you should feel comfortable risking your hard-earned money on this relatively conservative strategy. And when I use the word master, folks, I am talking about 3 levels above being pretty good at it. Okay, so one thing we all have in common now is we want to know how to maximize our profit. How do we make the most money? Here are a few ideas. First of all, if you're going to use this strategy, you're going to be making a lot of trades. You're going to be buying stocks, you're going to be selling options, you're going to be buying back options, and it's going to seem a little intimidating at first, because it did to me too when I was teaching myself this strategy, but once you've mastered it, it will become very much second nature to you. I promise you that. But you're going to need to use an online discount broker, not a full-service broker, because you don't want the commissions interfering with your profit percentages. So I have actually have a file of online discount brokers that charge very low fees and that are relatively reliable, that have been recommended to me by our members and folks that have attended my seminars over the years. And at the end of the webinar, I'll show you how you can get a free copy of this file. If possible, as we said before, use sheltered accounts, so Uncle Sam isn't your partner as you're generating this monthly cash flow. Now, when you're establishing your positions, you're going to need to use both fundamental and technical analysis, as well as some of the common sense principles that I'll be discussing with you shortly. In other words, you don't decide on using either fundamental or technical analysis or common sense principles. We're going to use all three. And finally, we're going to have a series of exit strategies in place to mitigate losses and sometimes turn losses into gains and sometimes even maximizing our gains. So let's first talk about fundamental analysis, and I'm certainly not here tonight to tell you how to fundamentally analyze the stock, but I'm happy to share with you how I do it as it relates to covered call writing. Now, over the years, I've had the most success using the Investors Business Daily IBD, what used to be the 100 list, which came out on their Monday edition. A few years back, they streamlined that to the IBD 50 list. So even though that's a great starting point, it doesn't give you enough stocks to screen to end up with a watch list, which I'm comfortable with, which is 40 to 60 stocks. So we need to use other resources. And I list some of these in my books and DVDs. One of them would be IBD's CanSlim, but there are many others. The BCI team also has a database of over 3,000 stocks that we've identified over the years as great covered call writing candidates. So each week we screen the IBD 50 list plus that database of over 3,000 stocks and present the list to our premium members of 40 to 60 equities to consider for covered call writing. But this is a process that you could also do by yourself. Now, once we've screened that IBD 50 and our database or other resources, then we run them through another IBD screen called the Smart Select Ratings, which basically is fundamental and technical, not only for the stock, but also for the industry that that stock resides in. And IBD will give you both letter and numerical ratings for these 6 categories. But you can actually screen very quickly because adjacent to that is what they call a checklist. And it's 6 circles, either green, yellow, or red. Green means the best performers in each category. So when we screen the Smart Select, we require all 6 of those circles to be green, and then it will pass that screen. If not, the stock is no longer considered. And the final fundamental screen we use is the MSN Scouter rating, which is a risk reward. What they've done here, folks, is they've taken 10 years of historical data, they've quantified it into equations, and ended up with a ranking system 1 to 10. And here's what it means. The higher the number, the more likely the stock is to outperform the S&P 500 over the next 6 months and with the least amount of volatility. Now, in the BCI methodology, we require a Scouter rating of 5 or higher. So let's now talk about some of the common sense principles, most of which you'll see no place else, but is an integral part of the BCI methodology as it relates to covered call writing. And the most important one is the first one. And most of the points that I make with our methodology I call guidelines because I like to give our members some flexibility. But this first one I call a rule. Never, ever, ever sell a covered call option if there's an upcoming earnings report prior to expiration Friday. And you'll see when I show you what one of our premium reports looks like that we highlight this in our report so our members can't make a mistake about this. There's way too much risk, and if you get burnt by an earnings report, then you could lose your entire month's profits from covered call writing. So we want to avoid that. Now, in that same regard, there are about 70 companies that trade on U.S. exchanges that report same-store retail sales on a monthly rather than a quarterly basis. And these reports act almost the same as earnings reports. So all 70 of these stocks are banned from consideration. And this is another file that we have for our members, and I'm happy to share with all of you folks attending this webinar tonight. And once again, at the end of the webinar, I'll tell you how you can obtain a free copy of this file. We require a minimum trading volume of 250,000 shares per day, and no stock or industry should represent more than 20% of your total portfolio. And the last common sense principle relates to the cash allocated per position. Now, if you owned a $15 stock and a $115 stock, and you had the same number of shares in each one, you'd be much more heavily weighted in the more expensive stock. We want to give approximately an equal amount of cash to each position. So let's say hypothetically you had a $50,000 portfolio and you were going to select 5 stocks. Well, then you would want to allocate approximately $10,000 per position. And in my books and DVDs, I show you how to do that. But generally speaking, you don't want to be too heavily weighted in any one position. Okay, we're moving along nicely tonight. Let's talk a little bit about technical analysis. Now, again, I'm not here tonight to tell you how to technically analyze your stocks. You may have favorite parameters you like to use. The only thing I would heavily recommend is that you use the same parameters, the same time frames on each chart. So when you plug in that ticker symbol, you'll be able to evaluate a chart in 2 to 3 seconds. Now, for those of you who have my books, I show you how to set up a technical chart in my first book, Cashing In on Covered Calls, and that's on page 85. And those of you who have my latest book, The Encyclopedia for Covered Call Writing, I dedicate 3 pages to that, 71 to 74, and it shows you how I set up a technical chart. But the first thing I look at is the moving averages, or I take a look at the chart pattern of a stock. Is it trending up, down, or sideways? And I use 2 moving averages here, the 20-day and the 100-day moving average. Now, if we want to show positive upward momentum, we're always going to want that shorter-term moving average to be above the longer-term moving average. So here you see the blue line represents the 20-day, and EMA means exponential moving average. And those of you new to technical analysis, that simply means that more weight is given to the more recent prices, so you get a quicker change in moving average, which is important to our only 1-month obligation. So what we'd like to see is we'd like to see an uptrending chart, which we have here. We'd like to see the short-term blue line above the longer-term red line moving average, so that passes. And finally, we'd like to see the price bars or candlesticks, whatever you prefer, to be at or above the short-term moving average, and we have that. So this is a very bullish moving average chart here. Now, as I said, and in tonight's webinar, we don't have time to get into details, but I do in my books and DVDs get into great detail on how to set up a chart. But generally speaking, let me just mention the other parameters to you. Underneath the moving average, which is at the top part of the screenshot, we have the MACD, which stands for Moving Average Convergence Divergence. And it's the subtraction of 2 relatively short-term moving averages. And again, we'd like the shorter term to be higher than the longer term, so we want the MACD to be above 0. And that's that thick black line you see in the middle of the screen. Now, the red line that's surrounding that black line is the actual moving average of the MACD itself. And once again, we'd like the MACD to be above its moving average. And when you subtract the moving average from the MACD, it could be quantified in bar chart form, those blue bars you see. So even if you know nothing about technical analysis, all you need to know here is you'd like those bars to be above 0, which you could see they are, and you'd like them to be ascending, which you could see they're not. They're actually descending. So as far as the MACD goes here, it's a mixed MACD picture. Now underneath that we have the stochastic oscillator, 3/4 of the way down. And you see here the black line represents the stochastic oscillator. And what that tells you is where is the price of the stock today compared to its previous 14 trading days. And once again, we'd like to see it ascending, but you see here it's actually descending of late. And it's broken below the 80th percentile, which is a bearish signal. So I don't want you to worry too much about that tonight, but just to let you know that we have a bearish stochastic oscillator. And the last parameter we use is the volume bars at the bottom. Now, we use volume to confirm the trend or the moving averages. So if you have an upward moving average but a declining volume like you see here, that could red flag there's going to be a change in the trend. So I said a whole lot, but what this all means is that we have a mixed technical picture here. And if we have a mixed technical picture and we're going to use this stock for covered call writing, now here's the important part, folks. I'm more likely to use an in-the-money strike, which will give me protection of the time value of my option premium. And we're going to show you how that works a little bit later on. But all of this works together. If we had a completely bullish technical chart, I'm more likely to sell an out-of-the-money strike. And I'll show you what a bullish chart looks like a little bit later on. This one happens to be a mixed chart. Now, here's what page 1 of our premium report we produce for our premium members. And I just want to show you the screening process that we just discussed. You could see the blue bar at the top, the symbol, the company name, and the rank, if it's in the IBD 50 or if it comes from other resources. The recent price. Now, only about half the stocks have options associated with them. So if a stock does not have options associated with them, obviously you cannot use it for covered call writing. And the rest of the screens you see here relate same-store retail sales, the banned stocks. The Smart Select is the fundamental and technical screens, minimum trading volume, and so on. You work your way into the technical analysis and earnings reports. Now, when I get an email from my team that the report has been published on our premium site, I immediately turn to the middle of the report, which is the running list, or you folks would know it as a watch list. We call it a running list because it's in a constant state of change. Every week it'll change a little bit. And you could see here, Google at the top is in a gold row. And that means it's reporting earnings that particular contract cycle. So it's not eligible, even though it passed all the screens, it is not eligible for covered call writing until the earnings report passes. And you can see we give the dates, the projected dates of the earnings reports, the name of the industry, so you don't accidentally use more than 20% in your portfolio, and much more information like the rank and other things like the beta or the historical volatility of the stock and dividend yield. So it's a lot of information in the report, but the main thing is the first page, the screening process. You must use, as I said before, fundamental analysis, technical analysis, and the common sense principles that we went over. So at this point in time, what we've accomplished is we've created a watch list of the greatest performing stocks in the greatest performing industries. But one thing is noticeably missing. We haven't made any money yet. And that's what we're all here for tonight. How do we generate that monthly cash flow? Well, in order to find out how much cash we could generate from selling options on those great performing stocks, we must first access an options chain. Now, this is simply a list of options prices for a particular equity. Whatever brokerage you're using is going to have this information, but there are many free sites also, like finance.yahoo, and you're going to see many of my trades showing options chains from that site. CBOE.com is another one. There are many free sites you can access for options chain information. Put in the ticker and then look for the options link. So this being the first options chain we're going to look at, let me just point out certain parts to you. and then in the future ones we'll just go right down to the dollars and cents. So on the column to the left, we put number 1 over it. That's the strike price column. Those are the prices that you can agree to sell your shares for. Now the stock we're looking at is Nuance Communications, ticker symbol NUAN. You could see I circled in red on the upper right that the current market value at the time that I made this trade was $24.07. Now, went down to the $25 out of the money strike, remember higher than the current market value. And let me just take a look now at column 2, which is the ticker symbol of the option. And you'll see certain characteristics you'll always find in that ticker symbol of the option. First of all, the ticker of the stock, NUAN, then the expiration date. You'll notice a C right in the middle. That means call option as opposed to put option. And then the strike price. So all that information will be there. Now the older option symbology is a lot different, and I'll show you some examples of that very shortly. Now let me take you, before we get into the actual dollars and cents, over to the last column we put down as number 3. It says open interest. That's the amount of open contracts for that particular option. So let me tell you the BCI guideline as far as whether to use a particular option. We want to have an open interest of at least 100 contracts and or a bid-ask spread of 30 cents or less. Okay, so let's take a look now at the bid and the ask columns. You'll see what that means. The bid column is the lower of the two prices. We always sell at the bid, the lower, and buy at the ask, the higher. The market makers pocket the difference. So they couldn't care less if we're buying or selling or winning or losing. They still pocket the difference between the bid and the ask, and that's called the bid-ask spread. In this case for Nuance, the bid is 75 cents, the ask is 85 cents, so the spread would then be 10 cents. So you can see here that it does meet a BCI guideline. As a matter of fact, 12,000 open interest contracts and a bid-ask spread of 10 cents. Okay, let's do the math. We're going to generate $75 per contract from selling one options on Nuance. On a cost basis of $24.07, that represents approximately a 3% 1-month return. Now, if Nuance goes from $24.07 up to the $25 strike, we've now generated an additional $93 in cash on the sale of the stock. That represents approximately another 4% profit. So in this case, we have the possibility of a 7% 1-month return. I want to remind you that the initial profit is time value only. If we sold an in-the-money strike, and you'll see an example shortly, we don't count the entire premium, only the time value of that premium. Here's Apple way back when it was $205.93. So let's take the strike column to the left, and we go down to the 210 out of the money strike. You'll notice, by the way, that strike prices move in $10 increments above 200, $5 increments below 200. You'll also notice that the symbology for the option is different. The reason I leave it in my seminars and webinars is that if you happen to read a book on options published before 2010, you're going to see these older type ticker symbols. Okay, let's make some money here. The 210 strike price, the bid column is $8.15. That means you're going to get $815 minus commissions, so let's say about $805 cash generated into your account from the sale of that option. Now, on a cost basis of $205.93, that represents approximately a 4% 1-month return. Now, if Apple goes from $205.93 up to the strike price of $210, we've now generated an additional $407 cash, or approximately another 2%. So in this particular example, we had the possibility of a 6% 1-month return. Here's Tupperware, selling at 44.14, scrolling down to the 45 out of the money strike, we generate $185 cash, or approximately a 4% 1 month return. And again, if Tupperware goes to the $45 strike, we've generated an additional $86 in cash, or approximately another 2%. So similar to the Apple example, in this case we have the possibility of a 6% 1 month return. Now, I want you to relax about the math, because at the end of the webinar, I'm going to tell you all how you can get a free copy of the Ellman Calculator. It's a calculator I wrote the equations for, which will do all the math for you. So you will be able to figure out what your initial return is, what your upside potential is for additional share appreciation, and what your protection is of the time value if you sell an in-the-money strike. So let's actually put this calculator to work. Let's take a look at the bottom row that I highlighted in yellow for VIT. And at the time I did this trade, VIT was trading at 1873. And looking at the out-of-the-money $20 strike, we see the option generated 90 cents, or $90 per contract. Now, when you use the calculator, you fill in the blue cells with the information that you've accessed from an options chain, and all of the calculations will automatically appear in the white cells to the right. So let's take a look at this trade for VIT. Intrinsic value, none, because this is an out-of-the-money strike, not an in-the-money strike. Upside, yes, $1.27. What that means is we have the possibility of the price of that stock going from 1873 all the way up to the $20 strike. And if that happens, we would generate an additional $127 per contract. So the return on our option, or RU, is 4.8%. That's $90 divided by 1873. That's our initial return. If the price of the stock goes up to $20, we've now generated an additional 6.8%. So we have the possibility here of generating an 11.6% 1 month return. Now, as far as downside protection of the option profit, 0. Now, that's very different than break even. We do have a break even, which is always the price of the stock minus the total premium. But in the BCI methodology, we're not interested in break even. We're interested in generating time value profit and then protecting that profit. So the only time you have downside protection of the time value is when you sell an in-the-money strike. So an example of that would be the row right above that. Price of the stock is still 1873, and the 1750 in-the-money strike, again lower than the current market value, is selling for 215. Now, we can't count that entire 215 as profit, because we're going to be losing $1.23 on the sale of the stock. That's the intrinsic value. You see that column there. That gets filled in automatically. The calculator will do that for you. So the $1.23 is subtracted from the 215, and that gives us a return on our option of 5.3%. Upside potential, none, because we're obligated to sell at 1750. The price of that stock can go to a gazillion. We're still only going to get 1750. However, we do have protection of that time value, because we are guaranteed a 5.3% profit as long as that stock does not go below 1750. So it can go from 1873 to 1850 to 1825 all the way down to 1750, and we're still guaranteed a 5.3% 1 month return. So what that line means is the following. We're guaranteed the 5.3% 1 month return as long as the share value does not depreciate by more than 6.6% by expiration Friday. Now, here's a strategy I use in my mother's account. I sell covered call options on exchange-traded funds. Now, an ETF is a mutual fund that behaves like a stock, and many of them have options associated with them. The advantage of an ETF is you need less cash to get started because you have instant diversification. There's also less management. We're not worried about earnings reports, etc. So those are the advantages of ETFs. The disadvantage is because you're dealing with a basket of stocks, there's less volatility in the underlying security, and therefore the option premiums are lower. So the goals are less for ETFs than they are for individual equities. For example, my goal with individual stocks is 2 to 4% a month. My goal in my mother's account with ETFs is 1 to 2% a month. So let's take a look at the ETF for the Qs. That's on the NASDAQ 100. You could see at the time on the upper right that this security was trading at $45.85. Scroll down to the $46 strike. And by the way, you'll notice that ETFs normally trade in $1 strike prices. And you'll see that the bid column shows 87 cents. So let's feed that into the Ellman calculator. And you'll see that the initial return on the option, the RU, is 1.9% with a possibility of another 0.3%. So here you have a possibility of a 2.2% 1 month return. Still not too shabby, but not as high as what you can generate from individual equities. So you should know the pros and cons of using ETFs versus individual stocks. Now I took this screenshot actually on a day that I was actually trading. And you could see on the upper right, kind of fenced in with that green box there, two stocks I was looking at, SWI and BWLD, and I put in 3 different strike prices for each. Now I just want you to kind of zero in on the right side there. You see the return on the option, upside potential, downside protection. Now, if I was bullish about the market and the chart technicals were bullish, I would look to get still my goal of 2 to 4% in the RU column, and then something that gave me some pretty nice looking upside potential. So I might look at that BWLD 90 strike, which gave me 2.3% initial return, with the possibility of another 5% if the price of the stock goes up to the strike price. And that would be an example of a bullish position to take. Now let's say I was concerned about the market, it was a little volatile, things going on in Europe, whatever, our government with the sequestration and all that. So I'm a little concerned. I might want the downside protection. So I might go to SWI 35 strike, which gives me still a very nice 1 month return of 2.3% with a 5.5% protection of that profit. Again, that's not the break even. All right, so depending on what your outlook is on the market, depending on the chart technicals, you could make an intelligent, non-emotional decision, and you're still getting a great return, and strike price selection will bring your returns to the highest possible levels. So here we go. Managing your covered call positions doesn't start after you enter your position. Starts before you enter your position. And we've talked about this. The stock selection process, fundamental technical analysis, and common sense principles like earnings reports, industry diversification, cash allocation, trading volume, all the things we talked about, just common sense. Now, the last 2 items I'd like to discuss with you in the time we have remaining are strike price selection, very, very important, and I'll briefly go over with you a couple of exit strategy examples. Remember, we have 3 strike prices to choose from: in the money, at the money, and out of the money. So let's talk about the pros and the cons. And in the money strike, we gave the example, you buy a stock for 56, you sell the $50 call option. Now, this is the most conservative way to approach covered call writing. I use this strategy for in the money strikes when the technicals are mixed and the market is bearish or volatile, because you have the protection of the profit because of the intrinsic value. The intrinsic value of the option protects the time value of the option. Look at it like you have an insurance policy on your position. And the best part about it is that insurance policy is paid for by the option holder, not by us. And again, the downside is you have no chance of any appreciation of the stock. But in a volatile or bearish market, that's the strike price you should heavily consider. The at-the-money strike is the one that will give you the largest initial profit, but will offer you no downside protection of that profit or any upside potential. And the last one, which is the most popular, the out-of-the-money strike, the example we gave, you bought the stock at 48 and agreed to sell the $50 call. Use that when you're bullish on the stock and general market conditions are favorable. So, generally speaking, use the out-of-the-money strike whenever possible. But if market conditions or chart technicals dictate, switch over to the in-the-money strike. So let's take a look at this chart and see what strike price we might want to consider. We could see the moving average very bullish, uptrending, short-term blue line above the longer-term red line, price bars at or above the short-term moving average. We see an ascending MACD histogram, those blue bars above zero and ascending. We see the stochastic oscillator, that thick black line 3/4 of the way down, ascending. We see volume confirmation of all of those bullish signals. We have a very bullish chart here for SWI. I'd be more likely to sell an out-of-the-money strike when I see a chart pattern like this one. Let's look at the options chain on that particular stock when the price was 37.03. Now you could see the open interest was well above 100 contracts, and the bid-ask spread was 30 cents or less. It could be either one. It doesn't have to be both. Now, let's focus in on three strike prices. The in-the-money 35, the slightly out-of-the-money 37.50. I couldn't find one that was exactly, but that's close to an at-the-money, just slightly out of the money, and the way out of the money 40. So let's take those bid column 285, 145, 55, and feed it into the Ellman Calculator on the upper right part of your screen here. And you can see we put the stock price, the option prices in here, and in the white cells you see the results. So let's say, for example, that I was a little bearish on the market. I have a low risk tolerance. I want some protection. What am I going to do? I'm going to opt for the 35 in the money strike. That's given me a very nice 2.3% 1 month return with a 5.5% protection of that profit, not the break even. Let's say I was bullish on the market, and of course we just saw a very bullish chart. I might opt for the slightly out of the money 37.50, which gave me a beautiful 1 month return of 3.9% with a possibility of another 1.3%. So here we have the possibility of a 5.2% 1 month return. And that's how we do it. We plug the numbers into the calculator. You could print out this sheet when you're ready to start making your trades. You say to yourself, is my market assessment bullish or bearish? Is my personal risk tolerance high or low? What did the chart look like? And you could make a very well-informed, non-emotional decision on which strike price to use. Okay, so let's briefly just touch upon some of these exit strategies. And this is such a critical part of covered call writing that so few covered call writers use. What most covered call writers do is they buy the stock, sell the option, and then hope for a happy result at the end of the month. You could mitigate losses, you can enhance gains. There's so much you could do to bring your profit level from so-so to oh my God. And that's what I want for you. So I break up exit strategies into two segments. The first half of the contract cycle and the on or near expiration Friday. So if the price of the stock is declining, you could use the rolling down strategy where you buy back the option and sell a lower strike in the same month. That'll give you some downside protection and generate additional cash into your account. And in my material, I give you examples of how to do this. Hitting a double, you could tell I'm a baseball fan, is where you buy back the option on a stock that's declined and then wait for it to bounce back and sell the exact same option in the same month. I'm going to show you an example of that. There's a strategy where the price of the stock goes so high that you can actually buy back that option at no cost to you and then sell the stock and use the cash to set up a second income stream in the same month with the same cash. It's a beautiful thing when you can do it, and it's not rare. Converting dead money to cash profits is where you basically just had it with the stock and you just want to close your entire position and use the cash to enter a new position in the same month. Now, the thing you need to know is that all exit strategies start the very same way. You buy back the option. Once you buy back the option, you no longer have an obligation. You simply own the shares, and then you're either free to sell a different option, the same option, sell the stock. You have so much flexibility what you could do once you buy back your short options position. So here's an example of where I actually hit a double. Now, I sold the option initially, STO means sell to open, at $4.10 where you see the green arrow. Once I did that, early in the contract period, the price of the stock started to decline. Now, I bought back the option, buy to close, BTC at 85 cents. In my material, I have a guideline, I call it the 20%, 10% guideline, that will help you decide when to buy back the option and at how much. But I bought it back at 85 cents. Now, I waited to see if the price of that stock bounced back up, and sure enough, it did. So what happened here, folks, is I sold the exact same option in the same month at 310. So I ended up with a net credit of 225, 310 minus 85. If I had 4 contracts, that's $900 extra in cash in my account from being prepared with this exit strategy. Now, I didn't catch that 310 at its peak, but I got it pretty high. Here's that chart of that option. You could see where I sold at 410, bought it back at 85, and then resold it at 310. It actually hit as high as over $4, but I didn't get it at its peak. I got it down here, generating a beautiful $225 cash profit from using this exit strategy. Now, let's move on to on or near expiration Friday. So let's say it's expiration Friday or the Wednesday or Thursday before that. You sold the 50 call, the price of the stock is 52. You know that if you take no action after 4 p.m. Eastern Standard Time expiration Friday, your shares are going to be sold. But you don't want your shares to be sold, let's say. You could do one of two things. You could roll out, which means you buy back the strike and sell the next month's same strike. So had you sold the April 50, you buy it back and sell the May 50. That's called rolling out. You could also roll out and up, a more bullish position. Buy back the April 50 and sell the May 55. You have to make sure that the stock meets all the system criteria, the most important one making sure that there's no earnings report coming out in the next month. And that will avoid share assignment or the sale of your stock. And again, all exit strategies start with the same thing, buying back the option. So here's a rolling out example. By the way, I do more than one contract, but I'm showing you this in one contract format, so the math will be a lot simpler. On October 23rd, I purchased 100 shares of ARMH at 32.10, sold STO, sell to open, the 33 call, out of the money call for 80 cents. That generated an initial 1-month profit of 2.5%. Now, as you could see on the upper right part of the screen, circled in green, on expiration Friday, the price of the stock was $34.31, or well above the 33 strike price. So, the share appreciation was from 32.10 up to the strike. I can't count it up to 34.31 because I'm obligated to sell at 33. So I generated an additional $90 in share appreciation, or an additional 2.8%. My total profit for that 1 month on this particular trade was 5.3%. Now, I had to make a decision. Am I going to buy back that option and sell the next month's option? Without even looking at an options chain, to buy back that 33 call, I know has at least $1.31 of intrinsic value in that premium, because the 33 strike is in the money by $1.31. and there's always going to be a few pennies of time value. So let's take a look at the options chain now for that 33 call. And here we go to the ask column. Remember, sell at the bid, the lower, buy at the ask, the higher. And we see $1.35. Well, that makes sense. $1.31 of intrinsic value and 4 pennies in time value since it's expiration Friday. Not much time value. So that's what it's going to cost us to buy back the option. Now let's look at the next month's strike price and see how much we generate by selling the very same option the next month. The 33 strike is selling for $2.10. Okay, so we get $2.10, that's our credit, and we pay $1.35, that's our debit. Feed it into the calculator, you see the $2.10, $1.35, generating a profit of $75 on a cost basis of $3,300. What this means, folks, is that we are guaranteed a 2.27% 1-month return as long as our shares do not depreciate by more than 3.8% by expiration Friday. If you like those numbers and they meet your goals, then this is a trade that you're going to want to move forward with. Now, I recommend that you keep some kind of a spreadsheet to keep track of your profits and losses. And for those of you who are premium members, we actually have a Schedule D in the expanded version of the Ellman Calculator, which can help keep track of that. But here's an example of a spreadsheet from several years ago. On one of my smaller covered call accounts, I invested $93,000 and generated $3,031 of profit for a 3.15% 1-month return. Now, the interesting thing about this spreadsheet here is you'll see BTC loss by the close. In other words, I closed out my JDAS position looking to hit a double, and lo and behold, I did. You see lower down. So I bought back the shares at $97. That's probably 6 contracts at 15 cents plus commission. And I sold the bounce back at $4.80. So I generated an additional $380 profit by being prepared with that hitting a double exit strategy. Now, many of you may have questions about strategies related to covered call writing. Perhaps you've even been asking Barry about it. I haven't been watching your questions. But I just want you to know that all this material is in my books and DVDs. Selling cash secured puts to enter a position at a discount. It's more of a bearish strategy. Some people like to use long-term options called leaps instead of buying the stock. There are pros and cons to that strategy. Buying protective puts called the collar strategy to prevent against the catastrophic drop in price. I have myself created a strategy for those of you interested in capturing dividends at a higher yield, where you sell a long-term option to decrease your cost basis. That's in my material as well. And finally, portfolio overwriting, where you want to keep the stocks that you already own. You don't want them sold, and there are ways of doing that slightly different than the strategy that I've described to you in tonight's webinar. So for those of you who want to master the strategy, I'm going to be showing you a discounted package of my books and DVDs. This is what it looks like on the store on my website. The 3 books I have are 3 top-selling books on covered call writing. My latest book, the Encyclopedia, is actually #1 selling book on Amazon.com on covered call writing. It's a very humbling experience, I might tell you. What we're offering tonight to all of those attending tonight's webinar is our most popular and comprehensive package. And that's my new book with our new DVD program, which comes with a companion workbook of all the stocks, graphs, slides, and charts in the DVD program. It also comes with 1 month's free premium membership. That sells on my website for $4.19. What we're offering to you folks tonight is a $50 discount by putting in promo code CASHFLOW, and you'll get a $50 discount off that package. In addition to that, we're going to ship you this for free, and this offer is good through this Sunday, April 28th. The shipping will occur as the orders come through. So those of you who order tonight, the shipping will occur tomorrow, and so on. And you can enter the store by this link, thebluecollarinvestor.com/store. You'll see this package, and remember to put in the promo code CASHFLOW to get your discount along with the free shipping. Now, I promised you a free access to the Ellman Calculator and free files, so here's where you get that. You log on to the website, thebluecollarinvestor.com. I've circled in red, it says free resources, including the Ellman Calculator, and that's the basic calculator. I've also written a user guide for it. You can also download that and print it out. And you just have to put in your email address and you'll have access to the calculator, plus all of the files, the broker file and the banned stock file that we talked about earlier in tonight's webinar. I also might add that there's a glossary that I've written for covered call writing. So for those of you who are going to use this strategy, you may want to bookmark that. Every term that you might be interested in relating to covered call writing, you'll find it in that glossary. So that being said, that kind of concludes tonight's webinar. It looks like I did pretty good with the timing, spent about an hour, just a little over an hour. I'm going to just ask Barry if he might unmute his microphone and let me know whether there are any unanswered questions that he didn't get to, and maybe between the two of us, we might spend a couple of more minutes answering any questions.
Hi, Alan. I've hit just about every one of them. There's one that I was responding to for Leon, and that question is what rollout means and what rollout and up means.
Okay, Leon, rolling out means that what you do is you buy back the current month's strike price. Let's say you had sold the $50 call. You buy that back, and then you sell the next month's $50 call. That's rolling out. Now, if you bought back the current month's $50 call and sold the next month's $55 call, that's known as rolling out and up. And that's a more bullish position to take because on the option side, you're going to generate less cash, but you're going to increase the value of your stock, and you're going to oftentimes give yourself an opportunity for share appreciation the next month. So depending on your market assessment, depending on the chart technicals, you could roll out to the same strike price or roll out and up a more bullish position to a higher strike price. Was that the only other one, Barry?
Yeah, that was the last one that was not addressed.
Okay, so then let me thank Tim again for inviting me to present this webinar. And
Thanks, Alan.
Hold on, Alan, there's one more question from Melody that just came in. Do you ever use the put option for downside protection?
Yeah, well, using the collar strategy is a strategy that some of our more conservative investors use. It's a good strategy. I have no problem with it. I personally usually do not use it because I take so much time and care to get into stocks that are more likely to appreciate in value and then have my exit strategies at hand to mitigate losses that I don't want to take in less of a profit by paying for put options. But it is not a bad strategy, and it's actually a decent strategy for those that have a lower risk tolerance. Once again, that's called the collar strategy, buying protective puts. So once again, thank you everybody for attending this webinar. I hope you found the information useful. You can reach me at Alan, A-L-A-N, at thebluecollarinvestor.com. You could reach Barry at thebluecollarinvestor.com. We answer all of our emails. And Tim, once again, thanks so much for the invitation.
Thank you, Alan, and thank you, Barry. Thanks, everybody, for being here. I appreciate it. You'll get the link to the recording in your inbox by tomorrow morning when you wake up, so we'll have that in about 12 hours. So make sure you go to thebluecollarinvestor.com. Alan's got a great site. He's got a great blog as well where you can keep up on all this stuff all the time when he's writing about some great investment ideas. So thanks both to you all, and thanks for attendees. We'll see you at the next webinar.
The organizer has ended the session.